What's up, you guys? So Web here from OneGlanceTrader.com, and welcome to part 2 of my $500 account challenge. And if you're brand new to this series, you can click the link down below, which has the full playlist. But in a nutshell, I'm taking a $500 trading account and looking to compound that account over the coming months and hopefully double the account value. And I wanted to document this process to show you how I'm approaching this. So for you guys that have only $500, $1,000 or $10,000, you can replicate this overall process, just adjusting it to your trading account size. And I'm trading options, and more specifically, I'm trading put credit spreads, and I'm only trading put credit spreads on Tesla. And if you're brand new to all of this stuff, again, I encourage you to watch episode 1, because episode 1 goes into what put credit spreads are, and hopefully I'll try explain as much as I can in this video to walk you guys through what's been going on. So just as a reminder, the first trade was that I sold the 900 put and bought the $895 put as protection rather, expiring December 3rd. So you can see here I sold a put and I bought back the 895 for protection. The difference between those two numbers was 65 cents per share, and as you know, when you trade options with one contract that I'm trading, it's 100 shares, so that is $65 net credit. And if you take the $65, divide that by my initial capital of $500, that is a 13% ROI. And I mentioned in the first episode that I'm looking to gain around 10% per trade. So after trade 10, in theory, I'll be looking to have doubled my account. And when I placed this trade, it was about 3 weeks to go till expiration, and what I like to do is review, depending on what happens to the price of Tesla, is look to roll out my option every couple of weeks. And that's exactly what I've done for this second trade. So I've just put the second trade on, and what I've done here is I've sold the 1005 and bought the 1000 put, expiring December 17th, so rolled it out by a couple of weeks. And when we say we're rolling back, rolling a put credit spread, in this case, what I've done here is I've rolled forward. So I've rolled forward and I've rolled up. And what that basically means is that I've bought back the 900,895 credit spread, which cost me $10. And again, just showing a screenshot of my trades here, but effectively of the 65 that was available, I was $55 in profit. So I decided there's no point me waiting until December the 3rd just to gain $10, where I've already gained 55 of the 65 available. So what I've decided to do here is close out this trade and open a brand new one. And the reason why that I made 55 of my $65, that if I load up TradingView on the weekly chart of Tesla, you can see here that Tesla has gapped up slightly and was a lot higher, was around, I think, 4% up on the day, but I think now it's probably only about 1 to 2% up now. It's pulled back slightly, but I kind of really probably wanted to open this put credit spread when it's lower, so I get a better credit, but it doesn't matter. And because the odds on Tesla going back down to the 900 mark, which is just below this gap over here, is extremely unlikely, according to the standard deviations and what the market is offering. So it was cheap to buy this option back, and what I've done is I've rolled up my strike. So I've now added an extra $105 to my strike, and now I have sold the 1005 put and bought the 1000 put for protection, and you can see what the numbers look like there. But what this results in is me gaining an $85 credit to place this trade. And for those who are interested in deltas, that is around, it was around a 0.3 delta, which effectively means that there's around a 30% chance that Tesla will close below 1005 by December the 17th. So if we look at the total net credit, because this, as you can see at the time of all these trades, I bought back and opened all together, and your trading platform kind of takes care of all of that. You just set what you want your new strikes to be, and it calculates what your net credit or debit potentially could be. And so if we take the $85 that I gained for the new option I sold, and bought back the first trade option for 10, I have a net credit of $75. And if we have a look at the first trade where I made $65, which is over here, plus the 75 I've gained, divide that by my initial investment of $500, that is an ROI of 28%, which is absolutely fantastic. And you guys remember my goal was 10% per trade, so I would have been happy with a 20% ROI, but I'm I'm above that now by 8% with the 28% ROI. And as you can see from the chart, the reason why I've gone for the 1005 is you can see here that this is, I think these they're called tweezer bottoms to a certain extent, where you've kind of got two lower wicks around the same area. See if I can zoom in slightly on here. That I think the 1005 level will act, or the 1005 will act as a good support level. Even if price starts getting to this area here, I'll have options available to me. So what my plan is to manage this trade, because I've got until December the 17th, I'll be setting an alert around the 1100 1100 or 1050 level. I'll be setting 2 alerts at that level, and if price gets somewhere in and around or in between those levels before my expiration and I'm feeling a bit uncomfortable, what I'll end up doing is rolling this option out by another couple of weeks, because what I don't want to do is let price get closer and closer to my $1005 put strike, which then will cost me more money to end up rolling this position further out. And the EV market has been rallying. A lot of the EV stocks are up. So I think overall, I'm hoping for a good week or so, or stay above 1,100. That would be the best thing, to let this option decay in time value for then me to pick up more and more of that $75 to make this option cheaper to buy back. So I really hope you guys enjoyed this episode. You got any questions, please comment down below. More than happy to answer it. Don't forget to like and subscribe, and I shall see you guys in the next video.